Capital Factory, and I heard this from 3 different folks, a shop called Hover City. It's basically short-term city in a box. I think we're going to see it in the Ukraine and Syria, Turkey. It can be made out of these 400 square feet smart homes out of one piece of metal. It's pretty slick. Great immigrant founder. I think goes in the spirit of what our VC panel said today. No, but it's off from one sheet, one piece of metal.
If the group isn't familiar with a company called IvyFON based in Austin, Texas, they are 3D printing homes out of what's the equivalent of a tube of toothpaste. They can print, and I'm gonna butcher the actual cost, but I think they can build like a 1,500 square foot home for 30 or 40 grand.
But don't brush your teeth with that toothpaste.
But I mean, it's game changing, truly. So there's some cool stuff going on down here.
Great. So with that, I want to introduce David and Gerry, and I think David came the farthest from New York today, so we'll be kind Texans here and let you kick it off.
Introduction?
Yes, please.
David Soares. I'm President and CEO of Lexden Capital and Lexden Family Office. Lexden Family Office invests primarily in real estate and also some energy-related infrastructure. Everything we do, which may sound a little bit dirty word in Texas, but everything we do is sustainable. I would say green in nature, but I would classify it as energy efficient, not green for green's sake. We are primarily right now focusing on in the real estate sector. We're focusing on workforce housing. This is why I'm here in Austin, not just to be at the panel, but also meeting with several land developers to see whether we can help finance those projects which have been stalled for the last 6 months in this marketplace, and right across the U.S. as well. So we're looking also in the Denver market as well, and the Tampa market, and parts of Ohio as well. So that's really what our focus is right now. We expect to build over the next 36 years, close on financing to build between 4,000 and 5,000 units, which will probably be at that point the largest build-to-rent single-family house owner in the U.S.
I know there's definitely need both on the workforce and the Class A that we're focused on. So congratulations on that front. Gerry, Troy.
Hi, everyone, and good afternoon. My name is Gerry Hedgcock. I'm CEO of Mirasol Real Estate Partners. We're a multifamily investment management platform that leverages technology to create new revenue streams, to cut expenses, and to really accelerate the value creation process, ultimately trying to compress that time period in order to return capital as fast as possible. And my background personally, I've spent the last 20 years working for Crow Holdings in our investment management platform, where we grew from a $250 million small family office to a sequential fund business raising over $3 billion per fund. I left a year ago to start this new platform. My capital partner is a gentleman by the name of Steve Wynn. Steve made a sizable fortune in the prop tech sector, where he founded a company called RealPage, which is one of the largest software as a service providers in the real estate industry. And it's so funny. As I've gotten to know Steve over the past year, I've learned, I think obsession might be an appropriate word with the term alpha. Everything we do is we think about alpha. What's different, right? Steve will openly say, I didn't make all this money by following the crowd and doing what everybody else did. And so what we're really trying to do is use my 20 years of institutional management practice as a foundation of what we're doing, but then to enhance that with new and really innovative ideas that we think are going to add significant value and outperform our peer set. And I think we've got some pretty fresh concepts that our industry, I think, is it's stale in some ways. And I think we've really brought new thought in leveraging technology in creative ways to really rethink some of them, maybe a stale mousetrap that we think will generate up to 600 basis points of alpha beyond our peers. So excited to be here and talk to you guys about it.
Well, since we're at South by Southwest, I'm going to put you on the spot, Gerry. Yeah. Let's talk about this alpha. What differentiates you guys from other investment shops? How's your strategy?
Yeah. Yeah, I mean, I touched a little bit on technology, but you know, there's three primary ways that we are different. You know, we are looking to change the way in which portfolios are traditionally constructed. If you think back to large fund managers, typical geographic diversification assumes that you buy, you know, a couple deals in Tampa, a couple deals in Denver, a couple deals in Austin, et cetera, and just spread it around. And there's nothing wrong with that strategy. I've done it my whole career. We're just going a different direction than that. We want to mean more in fewer markets. We want to be hyper local. And by doing that, we're able to create scale on a local level and then digitally connect those assets within a clustered area and share costs and resources across an entire portfolio of assets. Because the way it works in the business today, each asset operates as a standalone business. And we think there's a better way. And if you're able to centralize management and share resources and share those cost efficiencies across the portfolio, we think we can reduce payroll by up to 40%. So that's your largest controllable expense line item in an entire pro forma. Moves the needle significantly. We're also looking to kind of insert ourselves between internet service providers and the residents, where we effectively go out and we buy internet bandwidth on a wholesale basis and we sell at retail. And we still discount it to the residents, so they're still getting a discount relative to market rates, but we're able to manage to insert ourselves into that profit margin in between the two. And then the final strategy that we also are doing very uniquely is that we are accelerating any type of value creation through renovation and repurposing or renovation. We're looking to move that needle 3 times faster than our peers by renovating units while residents live there. That is something that candidly has not been done before, but we have come up with a strategy that we think is going to accelerate that process, which ultimately allows us to return capital faster to our investors, enhance yields, or just create a capital event earlier in our hold and enhance returns.
Gerry, that's dynamic. I've heard a little bit of each piece from different companies over the last 5 years, but nothing that has come together or a founder that has had the success such as Steve Wynn. What's your offer, my friend?
Oh, good question. Mine is rather straightforward, actually. I've been waiting for a few years to really take this plan to market, and the current credit crisis that we're in right now has fueled the need for capital on the development side. Everybody's sitting on the sidelines. We're not. So the alpha really is combining sustainable technology supported by Swedish technology from Europe, getting sovereign bank guarantees on the financing, which is unique, I think, to a large degree, except it's not played in the smaller space that I'm in. It's usually played in the $500 million space and up in infrastructure. But we're able to get down as low as $80 million in senior debt, construction debt, about 1.5 points cheaper than the market here, and get better leverage because we're also utilizing effectively a master lease from an insurance carrier, which I've negotiated over 4 years. So it's been a long time coming, and the market now has really created a perfect storm for us, Alexa. So it's the combination of the financing and the master lease enables us to go into markets like Austin, which is completely constipated right now on the vertical side, and go in and negotiate deals with landowners. So that's our it's not a secret sauce. I just combined other people's sources to make a dish.
Well, and David, if you can get financing in this market, you're one of the few who can. And so if you think about the fundamentals of this market, there's going to be a supply wave that's going to hit, at least in the housing sector or on the multifamily side. There's a lot of product that's coming to market in 2023 and 2024, but nobody's getting a deal financed this past year and probably at least for another 12 to 18 months. So when you think about the fundamentals as you move into 2025, 2026, I think those of us in the multifamily space are really excited about what's coming just because of the capital markets issue. We do not have a fundamentals issue. We have a capital markets issue.
That's right.
So if you're able to get a deal off the ground today and it takes 18 to 24 months to deliver, you're going to be in a great spot.
Well, it gets better. It gets better because we're only moving into those areas. I sit on some advisory boards for pension funds, and the long-term thought is that in the US, the tech-based growth markets are going to be like that for the next 10 to 15 years. So forget the mini recession we're going to be hitting over the next couple of years. We're going to ride right through that. If we, in my model, we're creating a completion guarantee on the construction. We figure 2 to 3 years on that side, and we've got a 5-year income and expense guarantee. So we're 8 years out before we have market issues. So we go right through all that. So it gets better in that sense. The financing, just so everybody knows, is not that complicated. It's basically it's unique in the sense that the Nordic countries, particularly Sweden, or spearheaded by Sweden, are supporting sustainable projects, whether it be infrastructure or real estate. Heinz did over $900 million in financing on 525 Greenwich Avenue. At the time, rates were a little bit lower. They borrowed at 2%. This was going back 4 or 5 years ago now. But that's an example of the finance. They only require 30% Swedish technology or Nordic technology to provide guarantees behind up to 100% of the qualified financing. You're not getting more financing than you might normally. You still have to underwrite. The deal has to underwrite. But my income expense guarantee enables me to push that envelope a little bit further because there's no absorption underwriting. I pay for that, but at the same time, I don't have to reserve for 18 months of stabilization. So it's a win-win scenario. This is the perfect storm for us.
Well, it sounds like you have a shallower J curve, right? Because you're not incurring those losses through having to absorb the product because you have that.
Well, it's not just that. That's true, but it's not just that. It's the fact that in this credit market, the lenders like the fact that they don't have to worry about absorption. And in this credit market, whatever the lenders like is what we do.
That's in every market.
Let me bump it up to some big macro. There's still low unemployment, but there's wage growth. How are you guys going about finding talent, and then how does this ultimately touch on your bottom line?
Yeah, I mentioned a little while ago about the idea of centralizing management and trying to come up with some unique ideas, and that really kind of comes to the heart of it. As we tech enable our assets and leverage our bespoke tech stack, we're able to cut headcount on site by almost half. And so what that enables us to do, our technology enables less people to do the same or better work. So if you need fewer people and you're spreading those costs amongst more assets, what it enables us to do is to pay above market. We can pay 20% above market rate to attract and retain the best talent in the business. So we have a better customer experience. We have more talented people. We have better reporting and better analytics. But we can then spread those costs amongst more properties and ultimately reduce our payroll 40%. So we think that that's a pretty exciting structure. And what's also really unique about it, if you think about at least the old operating model, the traditional operating model of multifamily communities, there's generally a team or 3 or 4 people in office that are all fighting for the same new lease and renewal bonuses. That's the way it works. You get $200, $300 for every new lease you sign, and you're kind of competing with your peers within the office. The way we do it, we have one person in the office. So that one person gets every renewal bonus. They get every new lease bonus. So it's very lucrative for those people. So it enables us to attract and retain the top talent.
My side, I mean, we mostly joint venture with best in class. For example, on the construction side, we're doing 2 projects with Skanska. They're Swedish. But so I don't really have, and internally we grow organically. So as we get into a region, hopefully we'll be shortly getting into this region, into the Austin market. And will be hiring some partners, I would say strategic partners that are experienced into this market. I still believe in the local real estate as local. There's no way that somebody, and I've done it on the lending side, and I've done it on the investment side, and I know that you have to have strategic local partners or you can't do real estate.
Just playing on that, I like to call you one of the early fathers of the bridge lending. I know we were talking about your career before. I think it'd be fun for the audience to just share a little bit there, when you learned it, what was unique.
Oh, bridge lending?
Yeah. How this plays into.
Well, I'm not that old. I started bridge lending. We ran lending in 2000. I guess that's pretty old. In the bridge lending market, you know, but then I owned a real estate residential mortgage bank in '91, which was before it became popular because they weren't trading on the secondary market that much then. So I'm a bit of a maverick in terms of getting in and seeing opportunity. But the bridge lending market, well, everybody's playing at it now. The difference is you've got to, I think, if you're out there looking to either invest in bridge loans, I'd be wary of the leverage model. You know, it can be dangerous, and especially if you're selling different tranches in the credit box. We've had that problem in the 2008-7 crash where multiple investors were involved in credit tranches, and no one knew what to do, who to sue, or who had the rights to do what, and there's a huge, you know, bowl of spaghetti to try and sort out. So I'd be careful about investing in multiple tranche bridge lending. But it's a good, you know, I still do it. Still do some lending in the space. There's opportunities out there. I find that the investing in quick loans, local underwriting is the best niche. If you can close in 3 to 5 business days, you get the best opportunities. But you have to have the reputation for closing in 3 to 5 days, and you'll get the best opportunities.
Speaking of reputation, Gerry, you were one of Texas' most notable shops for the first 2 decades of your career. Any golden nuggets you can share, maybe that are public now, that was ahead of the time?
And you know, I think discipline. I think that's the word that you have to stick to when you're a fiduciary, acting as a steward of someone else's capital. That's the end of the day. You have to put your investors' interest before your own. Making sure you don't get out over your skis on leverage. I think that's one thing that is been a part of my, you know, the fabric of who we were at Grow and who I am today is just not overextending yourself, having appropriate interest rate hedges in place, obviously in an environment we're in right now, and just having that discipline not to chase the deal, because as we've seen, those deals can run, and the fast money, boy, you may feel like you're losing out on a deal at one moment in time, but those sins all come to bear at the end of the day.
So we're going to tech down and have some tech rock stars and hybrids, tech real estate. Can you touch a little bit more on how the tech is influencing your investment strategy?
Yeah, you know, when I mention our tech, what's really kind of cool is how we came upon this tech, because some of the backbone of what we're doing was really born out of necessity during COVID, right? We were all trying to stay away from one another. We didn't want to get too close. How are we going to keep operating our communities while still trying to socially distance ourselves? And the traditional model was you walk into the office, you get a personal tour and walk you around a community, right? Well, that didn't work in COVID. And so self-touring came about. Self-touring took a lot of different forms. It's, hey, here's a site plan. I'm going to draw you a map with a pen and a Sharpie and just send you on your way. Oh, and here's like 5 keys. Go knock yourself out, right? And it's super disorganized and people get lost. And it's just not a crisp tour. But technology came about where all of a sudden you're able to now register on your phone. You have Blue Dot technology that enables you to guide yourself through a community, and you know exactly where you are because of GPS technology. We have smart access locks now across every single door in the entire community that enables you to get into those doors with your phone. Your phone becomes your fob. Like, how cool is that? You can not only just get into the model unit, you can get into every vacant unit on property. You can get in the fitness center, the gym. You can go at 12 noon, or you can go at 10 o'clock at night. You can go whenever you want to, because we know who you are, because you've already pre-registered. We've already kind of run a credit, or not a credit, but a criminal background check on you before you even walk into our doors. Something happens, we know who you are, because we know your phone accessed the door. So it's pretty cool what we can do now that again, really was kind of born out of COVID, but now we have a different use case to kind of rethink our mousetrap, which is pretty cool.
But then been using these technologies in Asia, so you could walk through buildings, virtually while you're in the US before you invest and buy.
Right.
But we're just a little bit slow. There's so much opportunity which you're realizing, factually realizing, in the US to actually improve on utilizing efficient technology. It's just efficiency. And other places on the sustainable side that I'm involved in, both on the infrastructure and the real estate side, the European technologies that we're not using here and don't think about don't cost more, but they save you money on the usage side. So it's just efficiency. Sustainability is about efficiency. This is what you say. It's just efficient.
It's efficient, and again, I feel like our industry is we're kind of archaic, and we're stale, and we're slow to innovate, and so we want to be the guys out there waving the banner, saying there's a better way. And it's funny, I listened to everyone's presentations today, and I'd never heard the term. Maybe it's a PE term about moats. I'd never heard that term. In the real estate world, moats don't exist. In the real estate world, we're all an industry of thieves and copycats. And so, do we have a moat around what we're doing? Not really. Do we think we can do it better than anybody else? Yeah. Is it going to stop anybody from trying to copy us? No, but what better form of flattery? And if they do it, that means we've done something right. And we'll have first mover advantage. And then it's incumbent upon us to stay on the forefront, to see around the curve, and keep coming up with that new thing, to keep challenging that status quo, and to keep reinventing the game. And that's something we talk a lot about. It's part of our ethos and who we are.
Speaking of common terms, interest rates. Rates have gone up recently. Want to get your take also on cash flows. See more coming in, coming out, particularly the projects you're working. And then how is this going to impact your valuation now and then ultimately when you transact?
Well, obviously for me, it's helping me because it's not, people talk about interest rates in a vacuum. It's not really, they're not in a vacuum really. Interest rates are one item, and we talk about interest rates because our federal government has only one button they can push. Interest rates go up or they go down. That's all they seem to be able to do. But that's just not the way the world works. From our perspective, interest rates are not the issue, but what's also an issue, I think, is the lack of liquidity. Not the cost of funds, but also the fact that the money is not available at the leverage that deals can command. If a deal can command in the private sector interest rates at 65% leverage at 9%, why wouldn't it be better leverage and more secure leverage at 6% in the capital markets? It would be the same asset if it's being underwritten to 9% at 65% leverage or 60% leverage would be a better loan, a more secure loan on the balance sheet at 6%.
But their cost of capital is so high that they still have to make a spread.
I think it's a game. I was in that game. We charge more because we can. When the banks go out, they come in without real planning. It's all about perception. We deal with real day facts every single day, and we're actually looking at really monthly what's going on with our assets, and we plan accordingly. Banks, they run with fads. So when they leverage too much on the wrong assets, and we would never leverage like that. When they don't leverage, they don't do money at all.
Well, and that goes back to the comment we made earlier that it's not really a fundamentals issue, right? Well, you and I are seeing what's going on the ground floor, what's happening with revenues and expenses and occupancy and rents and all those things. This is a capital markets issue, right? But the capital markets, unfortunately, they have a real impact on capital flows and valuations of our business. And if you look at where values are today versus where they were a year ago, they're probably at least 30% off, more in some asset classes. One thing that was my question from the peanut gallery earlier when Dory was speaking this morning. One thing that we have not been talking about today that I think has to be part of the conversation is the office market. The office market is systemically damaged. It is, and it is, you read about what's going on in the office sector. It is just the beginning. This is not, we're in the second inning of that game. There is a lot more to come. There's a lot more pain to come. I personally am a believer that there is a systemic change in the way companies do business and that work from home in some form or fashion is here to stay. And if you look at the impact that corporations are making, that the decisions they're making about their leases, and they may have 5, 6, 7 years left of term on a lease, and they are going to pay their rent. And that is fine. That's great. They're not going to default on that lease, but 7 years from now, they're going to downsize that lease. That's why I say we're in the second inning of a very long game, because so many of these leases have yet to have an opportunity to roll. Barney? It is. I think the winners and losers in the office game have to deal with quality. The Class A, the Class AAA space is still very coveted. People want to be there. It's the Class B and C space that is really struggling. And when you think about the cost, the values that these assets have historically commanded, and you think about the loans that are on those assets. I had a conversation with a colleague at one of the major banks that will remain nameless. And I said, what if you mark to market your whole portfolio, what's your loan to value on your office portfolio? And this is a household name that everybody's heard of at this bank. And they said there's not a single loan above water on their book. And again, you start talking about unrealized losses on these bank balance sheets. That's real stuff. And I'm not smart enough to tell you how it's going to ripple across the economic, landscape. But pay attention. That's going to be a big storyline.
So to answer your question, Marty, a little bit, I live in Manhattan. I've owned assets in Manhattan for almost 4 decades. So don't want to give my age away too much, but the market is on the office side is absolutely disastrous, particularly in the B class space. There's a big problem with the B class space in the older markets like San Francisco, New York, Boston, and Philadelphia, is that they're enclosed on 3 sides. So adaptive reuse, repurposing to residential doesn't exist. You'd have to buy buildings at a below replacement cost to a point where you can create insets for windows. Where you can't. There's no real adaptive reuse. There's too much space. The market for usage for office space in major cities has shrunk. It's just shrunk. We can talk about how it's going to change. No one really knows. We can talk about that it's gone down, but no one really knows how much. Wait a minute, what percentage is that? It's pretty low. Yeah, that's right.
So yeah, that's what I was going to say. What's that do to street level retail? And then
the multiplier effect, negative multiplier effect on all.
Play that out. What happens to our urban cores generally over time, right? If you've got empty buildings and businesses can't stay afloat, what happens to those urban cores over time?
You don't. Well, I can say there's a bright side to that. The bright side to that is our cities, our aged cities, need to be retrofitted for infrastructure badly. We've been patching on patching on patching. The top 10 developers, property owners in New York City got together in October, forget my years now, 2021. And the issue was, how do we make the city, the city wants to go by 2040, 100% electric. You hear that across all the cities. And the big guys are coming back, 180 million square feet, huge numbers of we're talking about. So we just built buildings and you're fining us because we don't meet local law 97. So we can't do this. And by the way, Con Ed's in the room and they're telling us that they don't have the infrastructure and they don't have the capacity to go completely electric. So by the market resetting, a lot of foreclosures, which will start to happen over the next couple of years, there's going to be a lot of resetting in the market, I think, to your point. They can't keep running these loans on the books that are above market value indefinitely. And the market will retrade. When we went through this in the early 90s, as you know, the market retraded really quickly. The private sector got together. The government didn't get in the way. They didn't subsidize. They said, you're going to have to mark to market. You're going to have to, all the big funds we have today, the private equity funds we have today, they were formed out of this. Fortress, all the big funds we have today, they're all formed out of that era of putting private capital together to reposition these assets. That's what we need to do in the big cities. But that's going to have to happen. People are going to take big losses, and they're going to do that probably over the next 2 years, I think. That's my crystal ball. And then we're going to start rebuilding these cities in a more adaptive, modern fashion. And that's what we need to do anyway. It's not unhealthy. Yeah, look, what's the golden rule in real estate? Buy below replacement cost. You've got to figure out what you're going to build, but you buy below replacement cost. If you can buy below replacement cost, then you know you're going to build. You can build something to the new market.
That's one of the real attractive pieces today in today's market is you look at the run up in replacement cost over the past 24 months, it's up 30% in 24 months. And so when you think about the value today to buy an asset versus, especially with elevated cap rates relative to replacement cost, I like the buy theory a lot right now. And if you can find a way to build going into 25, 26, like we talked about, when not a lot of the product is delivering, it's also a good trade.
One quick one here for time. Multifamily value adds seem to be the darling the last few years. A few of us here just got back from a non-institutional show, and the guru of this space, he's long $2-3 billion, and he invests little LP checks here and there. He said, about a quarter of my stuff is not paying distributions as expected. Are we going to see this also on the institutional side?
Depends on how they structure their debt. They have floating rate debt. Yeah, I mean it's gonna reduce just because you've got interest rate exposure and it's just eating up your cash flow. Now, if you put a cap in place, it's different, right?
That don't have a cap. When will they have to?
I would tell you that it depends on the deal profile. I think that the 80s, syndicator model, those guys there's going to be some carnage in that space. I think that if you are looking to pass the hat amongst your LP friends to country club doctors and lawyers, and you're either underwater, you're feeding your deal, or you've got a huge cap payment coming up, you're going to go to your investors and say, hey, I need more money. And they're going to, whoa, not me, Bubba. Like, I'm out. But if you have an institutional capital provider behind you, they're going to squeeze the sponsor and you're going to live to fight another day.
I don't really have too much comment on that. Really. I think that the plethora of investment going into multifamily, I look at it from a capital market standpoint. That is just, they didn't have, the real estate investors didn't have anywhere else to go. So that's why it became very popular. So yeah, it pushes up certainly public company values. The money has to go somewhere. If they've got money on the books, they've got to put it out. It's got to go somewhere, and it was multifamily.
Multifamily and industrial seem to be the two asset classes.
Well, industrial, yes, I'm sorry.
The fundamentals still remain solid in those two asset classes, but
no, I think now we're getting into the vision of smart cities. So I think there's going to be adaptive reuse for multiple different purposes, not just for residential. I think you're going to see over the next decade, 2 decades, that cities spread out more. There's going to be much more quality of life issues in center city. I thought in New York that, and they tried to do it, but it didn't. We have our issues politically in New York, and they agree on anything. but I thought during COVID that they would actually close off, like certainly a section of Manhattan where they would close off every other cross street to be only walking through to increase the quality of life and so forth. But that didn't happen. But these things will happen. And I think if you just see what's happening, Austin is a perfect city, by the way. You know, I was 3 years chair. Perfect example. And a perfect city, sorry. While I'm here, perfect city. It's the perfect example of smart city growth over the last 20 years. And I was chair of the finance committee for Smart Cities Council. We dealt with 180 municipalities, and Austin was front and center. There's the golden child for city planning. Although you should build a light rail, I think.
That one.
That's another one. That's the only thing that is needed to spur more growth in Austin, I think, as a light rail system. But yeah, it's going to be. I think yes, there'll be housing solutions because we need more affordable housing, and that's another whole nother panel really on the solution for affordable housing.
You know, in Dallas, for example, there's some people that have about 6 million square feet of office space in downtown Dallas tied up. And they're going a different direction as opposed to affordable housing. What they're doing is taking some of these bank towers that were built in the 80s, and they're trying to consolidate the office users into a top, call it third of the building. The middle third, they're trying to make it to convert into residential rental. And then the bottom third, they're trying to put, insert full service hotel with ground floor retail. So it's going to be mixed use from top to bottom. What they're trying to do is activate the buildings, and they're trying to activate the streetscape. And you do that by injecting people and businesses and livelihood. Then all of a sudden that rental experience becomes a more attractive value proposition. That office rental experience becomes a more attractive value proposition. So I think it's great in theory. Execution is going to be real tough.
I've actually seen a couple of deals like that that have gone through in Hawaii, in Honolulu, where they've actually taken office buildings and they've repurposed them in stratas versus just a whole building usage. I think you're going to see a lot more creative. We should be seeing more creative solutions. We've got better technology today than we've ever had. We should start using it.